Figma Inc. has made a striking debut on the public markets, with its stock price soaring 250% on its first day of trading, marking the largest initial public offering IPO day surge in over 30 years for a U.S.-traded company raising more than $1 billion. The design and collaboration software company, co-founded by Dylan Field, initially priced its shares at $33, but they closed at $115.50 in New York, giving the company a fully diluted valuation exceeding $65 billion. This impressive market entry comes after a failed acquisition attempt by Adobe Inc., which had planned to purchase Figma for $20 billion, a deal that was ultimately scrapped due to shareholder disapproval. The successful IPO not only highlights Figma's robust market position, but also underscores its strategic ambitions in the competitive landscape of design software, where it competes with giants like Adobe and emerging players like Canva. Figma's rapid growth is fueled by its expanding user base beyond traditional designers to include software developers and product managers, bolstered by innovative features like eye-driven tools. The IPO proceeds and elevated market capitalization position Figma well for potential acquisitions and further development of its product offerings, as it seeks to solidify its foothold in the creative tools market. Additionally, Figma's embrace of cutting-edge technologies, including AI and blockchain, signals its intent to remain at the forefront of digital innovation. Figma's financial performance is notable, with growth metrics surpassing many large-cap software firms, and a net dollar retention rate over 130%. The company's IPO success provides it with a strong capital base, enabling it to pursue strategic M&A opportunities, which CEO Dylan Field has indicated as a priority. The stock's performance also triggers significant performance-based compensation for Field, further aligning his interests with the company's long-term success. As Figma continues to navigate its post-IPO phase, its strategic moves will be closely watched by investors and competitors alike, as it leverages its newly acquired public status to drive further growth and innovation.
The recent imposition of increased tariffs by the United States on New Zealand exports has led to a notable downturn in the NZ stock market, particularly impacting Fisher & Paykel Healthcare, FPH. The tariffs, raised to 15% from a previously expected 10%, caught the market off guard, resulting in the S&P NZX 50 index closing down by 0.74% at 12,729.40. Fisher & Paykel Healthcare, a major player in the market with significant manufacturing operations in New Zealand and Mexico, saw its shares drop by 2.17% to $36. This decline was mirrored by EBOS, another major medical supplies distributor, whose shares fell by 2.25% amid speculation of its potential inclusion in the ASX 200 index. The tariff changes have introduced uncertainty into the market, with analysts suggesting a potential 1 to 2% impact on FPH's earnings. The market reaction was somewhat mitigated by the strong annual results reported by ResMed, an Australian-US competitor in the respiratory products sector, which posted a 37% increase in net profit. Despite this, the broader market sentiment remains cautious, with other sectors like seafood exporter Sanford also experiencing declines. Looking forward, upcoming labor market data from Stats NZ and GDP estimates from the Reserve Bank are expected to provide further insights into the economic landscape, with predictions indicating a potential rise in unemployment and a slight contraction in GDP.
Silence Therapeutics plc, a biotechnology firm listed on NASDAQ under the ticker SLN, has received an average price target of $33.83 from analysts, with a consensus recommendation of moderate buy. Despite this optimistic average, the stock has experienced divergent opinions among analysts. Notably, Goldman Sachs and Wall Street Zen have issued sell ratings, with Goldman Sachs lowering its price target from $4 to $3. In contrast, H.C. Wainwright and Chardon Capital maintain buy ratings, with significantly higher price targets of $75 and $35, respectively. This disparity highlights the uncertainty and varied expectations regarding the company's future performance. The company's financial performance has been underwhelming, with its latest quarterly earnings report showing a loss of 60 cents per share, substantially missing the consensus estimate of a 18 cents loss. Revenue also fell short of expectations, coming in at $0.14 million against an anticipated $3.58 million. These results reflect operational challenges, as evidenced by a negative return on equity of 56.17% and a net margin of -260.55%. Institutional investors, who own 98.73% of the stock, have shown mixed reactions, with some increasing their positions significantly. Overall, while the company's focus on Cerna and precision medicine offers potential, its current financial struggles and analyst divide indicate a volatile outlook.
Sun Pharmaceutical Industries shares dropped by 4% on August 1st, following the release of their June quarter earnings, marking it as the worst performer on the Nifty 50 index for the day. The Mumbai-based pharmaceutical giant reported a 16.6% increase in its consolidated profit before tax and exceptional items, reaching 3,991 crore rupees for the quarter ending June 30th. However, the company faced a one-time charge of 818 crore rupees due to asset impairment and a legal dispute settlement, which led to an overall profit decline of nearly 20% year-on-year. This mixed earnings report prompted varied responses from brokerages, with Investec downgrading the stock to sell due to anticipated weaker earnings in the upcoming quarters, while others like Choice Equity Broking and HSBC maintained more optimistic outlooks with add and buy ratings, respectively. The market reaction reflects broader concerns and opportunities within Sun Pharma's strategic outlook. Despite the temporary setback in margins due to increased R&D and promotional investments, analysts like those from Choice Equity Broking expect long-term growth driven by new product launches, particularly in innovative drug categories. Additionally, Sun Pharma's robust U.S. manufacturing base offers some protection against geopolitical tariff risks. The company's focus on expanding its specialty product portfolio in oncology, ophthalmology, and dermatology is seen as a key growth driver, supported by its strong balance sheet. The varied analyst ratings and target prices, ranging from 1,825 rupees to 1,999 rupees, indicate differing perspectives on the company's ability to navigate current challenges and capitalize on future opportunities, underscoring the importance of strategic execution in its specialty and branded product segments.
The inaugural Edinburgh Finance Festival, scheduled from September 15 to 26, 2025, is set to position Scotland as a key player in ethical and sustainable finance. Organized by the Global Ethical Finance Initiative, GEFI, the event will host over 2,500 delegates from major financial, tech, and energy sectors, contributing an estimated £1 million in gross value added to Edinburgh's economy. The festival will feature a series of conferences and summits, including the Scottish Renewables Onshore Wind Conference, the FinTech Scotland Festival, and the 10th Ethical Finance Global Summit. These events will address critical themes such as green finance, sustainable growth, and the energy transition, underscoring the increasing importance of aligning financial strategies with global environmental and social goals. Key figures such as Deputy First Minister Kate Forbes and Chris Hayward, Policy Chairman at the City of London Corporation, will lead discussions on pressing issues like U.S. tariff policies, global economic uncertainties, and the role of finance in achieving a low-carbon future. The festival aims to foster collaboration among policymakers, industry leaders, and experts to share practical solutions and drive change towards a more equitable and sustainable financial system. By highlighting Scotland's historical and ongoing contributions to ethical finance, the festival seeks to reinforce its status as a global hub for responsible financial practices, offering a platform for innovation and dialogue in the face of growing climate and economic challenges.
Algonquin Power and Utilities Corp. ZAQN has been assigned an average price target of $6.63 by 6 research analysts, indicating a consensus hold rating for the stock. This follows recent adjustments from major financial institutions, including BMO Capital Markets and National Bank Financial, both of which downgraded their ratings from strong buy to hold. TD Securities, however, slightly increased its price target from C$6.00 to C$6.50, maintaining a hold stance. The company's stock opened at $8.17, above its average price target, reflecting a market capitalization of $4.43 billion. Algonquin's financial metrics reveal a P/E ratio of -4.10, suggesting negative earnings, and a PEG ratio of 1.07, indicating potential growth relative to its earnings. The company's high debt-to-equity ratio of 154.35 points to significant leverage, which may impact its financial stability and flexibility. Algonquin Power and Utilities, with over $16 billion in assets, operates through its regulated services and renewable energy groups, serving over 1 million connections in the U.S. and Canada. The mixed analyst sentiments and financial indicators highlight the cautious market outlook, suggesting investors should carefully weigh the company's growth potential against its financial leverage and current market valuation.
AutoZone NYSEAZO and Driven Brands, NASDAQ DRVN, are both key players in the automotive retail and service industry, but their financial performances and market positions differ significantly. AutoZone, with a gross revenue of $18.90 billion and a net income of $2.66 billion, showcases robust profitability and stability, reflected in its higher earnings per share of $147.75. In contrast, Driven Brands reported a gross revenue of $2.34 billion, but faced a net loss of $292.50 million, translating to negative earnings per share of $1.81. AutoZone's higher price-to-earnings ratio of 25.46, compared to Driven Brands' -9.34, indicates a more favorable valuation by the market, although Driven Brands appears more affordable in terms of price-to-sales ratio. From a risk perspective, AutoZone's beta of 0.39 suggests lower volatility compared to the S&P 500, making it a potentially safer investment, while Driven Brands' beta of 1.09 indicates higher volatility. Institutional ownership is strong in both companies, with AutoZone at 92.7% and Driven Brands at 77.1%, signaling confidence from large investors. Analysts have a consensus target price for AutoZone at $4,087, suggesting an 8.64% upside, whereas Driven Brands' target price of $21 suggests a potential 24.26% upside. Despite AutoZone outperforming Driven Brands on most financial metrics, the latter's higher potential upside could attract investors looking for growth opportunities.
In a comparative analysis of Nokia, NYSE NOC, and Juniper Networks, NYSE JNPR, Nokia emerges as the more favorable investment choice based on various financial metrics and analyst evaluations. Nokia reports significantly higher revenue and net income figures, with $19.25 billion and $1.38 billion respectively, compared to Juniper's $5.20 billion in revenue and $287.90 million in net income. Additionally, Nokia's lower price-to-earnings (P/E) ratio of 20.35, as opposed to Juniper's 38.05, suggests that Nokia is more affordably valued relative to its earnings. Analyst consensus projects a 41.89% upside potential for Nokia's stock, significantly surpassing Juniper's 0.13% potential upside. Despite Juniper's slightly higher net margin of 6.78% versus Nokia's 5.30%, Nokia offers a more attractive dividend yield of 2.9% with a sustainable payout ratio of 60%, compared to Juniper's 2.2% yield. Institutional ownership is higher for Juniper at 91.9%, indicating strong large investor confidence. However, Nokia's broader analyst recommendation score of 2.60 compared to Juniper's 2.20 reflects a more positive overall outlook. Nokia's lower beta of 0.91 suggests marginally higher volatility than Juniper's 0.8, yet both remain less volatile than the S&P 500. The analysis underscores Nokia's stronger position in terms of valuation, growth potential, and analyst sentiment, making it the superior choice for investors seeking value in the technology sector.
Archer Aviation Inc., NYSEACHR, has received a consensus recommendation of moderate buy from analysts, with 8 out of 9 brokerages assigning a buy rating and 1 recommending a hold. The average one-year target price for the stock is set at $13.13, indicating a positive outlook from analysts. Recent reports by Canaccord Genuity Group, UBS Group, Needham & Company LLC, Cantor Fitzgerald, and H.C. Wainwright have all reiterated buy ratings, reflecting confidence in Archer Aviation's market position and potential growth. The company, which specializes in electric vertical takeoff and landing (eVTOL) aircraft for urban air mobility, is currently trading at $10.02, with a market capitalization of $5.50 billion. Financially, Archer Aviation reported a better-than-expected earnings result for the last quarter, with a loss of 17 cents per share compared to the anticipated 21 cents loss. Institutional investors, including Vanguard Group Inc. and Renaissance Technologies LLC, have shown significant interest, with hedge funds owning over 59% of the company's stock. Despite insider sales, the strong institutional backing and analyst support suggest a positive market sentiment and potential for future growth in the burgeoning urban air mobility sector. This sector is gaining traction as companies and investors look for sustainable and innovative transportation solutions.
Heartland Express, Inc., NASDAQ HTLD, a prominent player in the transportation sector, has been given a consensus rating of reduced by analysts. According to a report by MarketBeat.com, the company, which specializes in short to medium and long-haul truckload services across the United States and Canada, has seen its stock downgraded by several analysts. Wall Street Zen has shifted its stance from hold to sell, while JP Morgan Chase & Company has reduced its target price from $10 to $9, maintaining an underweight rating. These downgrades are accompanied by a consensus 12-month price target of $9.63, reflecting a cautious outlook on the stock. The financial performance of Heartland Express has been underwhelming, with the company reporting a 23.4% year-over-year decline in revenue to $210.39 million for the latest quarter. Furthermore, it posted a negative earnings per share (EPS) of 14 cents, missing analysts' expectations of 8 cents. The company's negative return on equity of 4.42% and net margin of minus 3.85% underscore the challenges it faces in the current market environment. Despite these setbacks, insider activity shows significant purchases by key executives, indicating confidence in the company's long-term prospects. Institutional investors hold a substantial 53.45% of the stock, suggesting a continued interest in the company despite recent performance issues. As the transportation sector grapples with economic uncertainties, Heartland Express's strategic decisions will be pivotal in navigating future growth opportunities.